Okay, so another attempt at another SA2 paper. It's a really short question, just three sub questions. So we have our scenario here. A proprietary life insurance company currently writes only without profits term and conventional without profits endowment insurance business and is considering purchasing a book of unit-linked group personal pension business. So one thing that just jumps out to me is the fact that they only write with our profits business, like as a whole, and they don't have any experience in writing direct participation products like unit linked. The second thing is that these are endowment assurances and also term assurances. So an endowment assurance can qualify as a retirement product if the term is greater than 5 years and if there aren't any significant withdrawals within the endowment within those 5 years. So they might have actual experience in Regulation 28 or writing retirement products, but that's still a bit unknown. But here they're stepping into a new arena because they're writing unit-linked group business. So they're taking on group business. Before they might actually have only been writing individual business, and now they're looking at group business. So there's that whole mismatch there. It's unit linked, which is a direct participation product, so they don't have experience with that. And then it's also a pension business, which they might not have experience unless their endowment business actually fits the criteria to be considered a retirement product. So those are sort of like the things that come out to me with this proprietary life company that taking on this business. And then there's also the regulations of, Regulation 108, GOI 6, and Section 50 of the Insurance Act, which go into detail on the handling of the independent actuary of the significant transactions or transfers of business and the sort of guidelines that should be um, followed then. So that's what pops out to me immediately on first look of this question. And we are tasked with, first and foremost, we need to describe the factors to consider when determining the price to pay for this business. So we're actually going to be buying this business from another insurer, or maybe it might be a retirement fund. So first things first, within pricing of anything, there's probably going to be some sort of discounted cash flow model that's going to be used, and it's going to be discounted off of the future profits of this business. So I'm just going to go through my a basic answer and understanding of the factors that I thought were um, important in determining the price, and then we'll go through the memo's answer. So first things first, since this is a unit-linked business, there's a unit reserve and there's a non-unit reserve. So the unit reserve obviously contains the assets that are backing the benefit payouts that are going to be paid to the policyholders. So if we're actually going to be taking on this business, we are presumably going to be buying up all of the underlying assets or the assets underlying the unit reserve. So these assets can range from equities to property. So we need to actually have pricing mechanisms to price these things. And then I gave like a couple of suggestions on how to price these assets and in other metrics and performance metrics and appraisal values that can actually be used when valuing the assets. Then there's also the embedded value. So the embedded value is usually used by investors to look at whether they should actually contribute capital to a proprietary life insurance company or not. So it's pretty much a standardized format of comparing different profitability values or future prospects of insurance companies. So although we aren't taking over the entire insurance company, we're only taking over a certain line of group business. I still think the embedded value is important because the value of an insurance company is really the sum of the value of the underlying policies, and that is the embedded value. So if we know the embedded value, then perhaps we can extract the contribution of the group unitized business to the embedded value, and that will actually help us to decide on the value of this line of business. And the embedded value should actually be just included and it should be reported by the company. I also go into a little bit of detail on how to calculate the embedded value if this isn't the case. Some certain considerations and assumptions that need to be taken into account as well. Then there are certain assumptions. So right now we're writing term insurance and endowment insurance, both without profits. So we might not have the IT systems and staff training required to actually take on this business. So we have additional expenses to take into account, and these expenses are probably going to be included within the acquisition costs. And then if there's additional tax liabilities that's on the actual business, so let's say there's some obligations that we might not know of that are actually present within the business, like tax liabilities, we actually need to take this into account as well. So they might be owing tax, um, and they haven't paid it yet, and then we have to pay it, so that needs to be included in the price. Or um, they might be owed tax, and we need to take that into account. And then the revenue is going to be based on the charges from the unit fund, so we might need to project, um, the cash flows from the non-unit fund, the cash flow from the unit fund, and then just add a couple of margins for the projections. And then the margins for the additional risks, or the new risks that will develop from us actually taking on this business. Um, then after that, there's some regulatory considerations. Um, so again, I mentioned the three prescriptive regulations that go into detail with regards to this transaction. Um, this entire transaction is usually very expensive because we need an independent actuary, we need auditors, and there's also other transfer duties and excess duties. So the cost of regulatory compliance should also be taken into account. Now, looking at the memo actually agrees with me about looking at future profits and income from management charges. The cost of administrating the business I also mentioned, which is estimated on unit costs. And then here, I actually neglected to mention this point, which is the fact that the unit fund has internal managers, and the internal managers, we it's either we get to keep them or we don't. If we get to keep them, then that's all well and good. We need to take into account their management fees, commission structures, etc., etc. If we don't, then we need to look at the costs of actually looking for new investment managers, and so on and so forth. And there might be related costs with that. So I neglected to mention the actual underlying investment management considerations. And then here, I actually mentioned in the embedded value section the value of new business, future contributions, but I neglected to mention top ups, um, and also the existence of like new members joining the scheme. Um, And then there is also the assumption of policies being paid up and transfers out of the funds that I did not mention actually. And then there is the past experience for the increase in alphas, which I mentioned. The once-off costs, like the purchase process, the legal costs, and post-transfer activity, I mentioned. And then I didn't explicitly mention the risk discount rate because I mentioned the cost of required capital, which implicitly includes the risk discount rates. So maybe I should have explicitly mentioned the risk discount rate and that the future revenues should be discounted at the RDR. with the suitable margin, which I did mention, the margins that need to be added for the risks. Um, and then there needs to be assessment of the value of the future business and future sales, which I mentioned. And there, I did not mention the fact that this assumption, the value of the future sales, would be based on market analysis and our own distribution capacity. I also didn't mention the fact that we can also sell these new policies to our addition or to our existing customer base. So we already have a customer base that we can actually sell these policies to, which might actually boost the new take up. I neglected to mention that. And then the best estimate assumption was included. Um, the tax position, the reason for sale, I did not include, and the additional risk from lack of data. I mentioned that there are data requirements in certain asset calculations. However, I didn't take into account the risk from the lack of data. And then there's synergies like economies of scale, capital, which I did not mention. How competitive the bidding is a strange point for the memo to say, because I would assume that this was an illiquid transaction, but meaning that there shouldn't be many people that are actually bidding for this because the actual market for this type of product would be like liquid. But I guess that is something to take into account and that should be mentioned. And then prices in recent deals. Again, I don't know if this is a strong point because this is such a bespoke transaction that I don't think it's happened before that we can actually latch onto the price. But um, recent similar deals, yeah, it could be useful. Well, gave practical examples like the systems issues could be the units being priced improperly, which means that we might pay too much or pay too little, and that means that we need to hold capital for that sort of risk. And then there's also the fact that if we misprice units, then we are mispricing or we're collecting insufficient management fees because these are actually based off of the value of units. And then we need to reserve for that. And then the operational risk, we also need to take into account. So we need to subjectively evaluate the likelihood of the risk and the financial impact. And there's also reputational risk, which might cause policyholders to become paid up or transfer funds or a decrease in new business volume, which also needs to be estimated and accounted for. And then we need to perform an ORSA, which reflects all of the above risks. And all in all, it would increase the capital requirements, and these increase in capital requirements would most likely be done in the form of an increase in discretionary margins. So that was sort of like my take on it, a very practical approach to the whole unit linked issue. The memo said um, any risk in regulatory capital assessment, it forms part of UK Pillar 2. So there's three pillars of the Solvency 2 regulation. The first is the MCR SCR. The second pillar is the ORSA and the actual internal control, risk management, and the third pillar is disclosures, market conduct, that sort of thing. So I mentioned ORSA, but I didn't explicitly mention pillar two because ORSA is in pillar two, so maybe I should have mentioned that. And then here I also mentioned the assessment of the operational risk, and then the estimate of the cost, and then the overall risk assessment, etc., etc. But I didn't mention the correlation between events and also the accumulate overall operational risk with other risk types. And then I also didn't mention any diversification events upon operational issues. And I also didn't mention that capital requirements can be reduced by mitigating actions, which I should have mentioned. Cool. Then there is the last bit, the last part of the question, which is outlining how the company could implement a risk management system to control this systems risk. I went into detail about the framework that they could use. So I suggested an ERM framework and a three lines of defense. I described the first line of defense, which is um, them actually having rewards and incentives to reporting risk events and creating a risk taxonomy and or being educated on it, and then also pointing out hypothetical events that could occur, and then how the beneficial effects of early detection of this risk. The second line of event, which is the oversight, and they have monitoring and risk reports. So these guys look at the risk reports that are prepared by the first line of defense. They provide this template, and they also have quantification models to quantify this risk, like tail value at risk and value at risk. They also have key risk indicators, key performance indicators, and if these are breached, then there needs to be remediation plans. And the third line of events is internal audit reports, give an objective view. And then the enterprise risk management is just to view how this risk relates to all of the other risks in the business. So I felt that was a very overarching and solid answer. Then here the memo said the first step is to understand and document the process of the risks, and this may include training standards for the staff or checking procedures for system input. So they actually gave an example. I mentioned the risk committee and the risk control owners. I also mentioned the value added activities and the key performance indicators. And yeah, so not too challenging, not too much challenge there.